Welcome to the Frostro deep dive into unlisted markets. With a backdrop of interest rate rises, inflation, and fears of recession, the private equity and venture growth capital investment trust sector has seen discounts widen to extreme levels, with some trusts still trading at over 50% discounts. These share price movements stemming from concerns over current portfolio valuations and some high-profile mishaps in the sector. However, to assuage these concerns, we are delighted to welcome Tim Levine from Augmentum Fintech to discuss Augmentum Fintech's recent results released just last week, as well as the state of health of the UK and European fintech universe in general and his outlook for the future. After his presentation, there will be a Q&A session. Please use the center button at the bottom of the screen marked Q&A to submit your written questions anytime during the webinar. I will now hand over to Tim.
Many thanks, Matt, and good morning, everybody. Great to have the opportunity to speak to so many existing investors and obviously those unfamiliar with the Augmentum proposition. The plan really is for me to give you a sense of what we're seeing at the coalface in terms of deal flow, volume of capital being deployed, talk a little bit through portfolio, some of the underlying trends, and how we see the outlook for 2023. Plan will be to talk for about 25-30 minutes and then open up to the floor. So please do start fielding your questions. So what have we been seeing? And I think it's hard to talk about the year almost gone without reflecting back on 2021 and what happened in general in the venture capital ecosystem, but also in the fintech ecosystem here in Europe. And I think what we saw in 2021 was a year like no other. It is clear to us and to pretty much everybody else now that it was an outlier year in terms of the sheer volume of capital. And I think one of the things that we have always felt, and I think the data is starting to really play this out, is actually, despite the fact that it was a year on a multiple of 2.5, 3x, we actually think it was much more significant, because if you look at the year-to-date deployment in the venture capital and fintech financing, the amount of money, in particular in Q1 and to a certain extent with the front end of Q2, was actually a lag effect from the end of 2021. Investments that were made, closed, not announced, or were agreed and closed in the first quarter of 2022. So it is an understated number, and we think the real number is probably closer to 160, 170. So I think if you were an outside observer looking at the year to date saying, well, actually, I don't know what all the fuss is, capital is flowing back into the venture capital market, the fintech market, I think the picture is more like what we saw in 2018, 2019. And I think when we see the numbers come through in Q4, you will see a further drop in the market. So the normalized number, we would think, will be reverting to the more recent historic norm, 2018, 2019, where we would expect next year to see those types of levels. So where did all this capital go, and where have we seen the biggest drop-off to date? So I think if you look at the market, you can see that the area that saw the biggest valuation inflation was what we would define as the late stage. So pre-IPO, maybe kind of even, one round before that, but kind of those traditional growth rounds. And the reason we saw such huge and unprecedented inflation in those rounds was the sheer volume of money that was coming into the market from investors that we'd not seen in any material way in the past, whether it's sovereign wealth or hedge funds in particular that were looking to get any form of exposure. And frankly, we're looking for beta when our job is to look for true alpha in this market, but they had such significant capital pools that they needed to move the needle. So investing in early stage Series A, writing $5, $10, $15 million checks to them really wasn't moving the needle. They needed to deploy 100, 200, 300 million in one single investment. And that really fueled this artificial high at the growth round, at the pre-IPO round. They were pointing to the listed market, seeing them forward revenue multiples being applied there, working them back to the unlisted market, the private markets, and justifying some pretty kind of heady forward revenue multiples. We have really started to see that late stage market really pull back. I think the good news for us as an investor that largely focuses on the earlier stage at the first point in which we invest, so the Series A, so we're not focused on the seed or the pre-seed. We want to see proof of concept. We typically want to see revenues, but ultimately it's our job to get in before the vast majority of the market is aware or has a desire to take the kind of risk that we would look to take. That has been a little bit more moderated. At the same time, we haven't seen the same level of sell-off that we see in the late stage. And when you look at the most active investors in 2021 and you scroll down the list of names, these are names that certainly from our point of view, many of these names we'd never heard of in the venture space. Yes, we'd heard, of course, of the likes of Temasek and Franklin Templeton, but these are investors that weren't historically particularly active in the venture space and in the fintech space. And you can see in many respects a dramatic reduction in the number of investments that they have made so far compared to 2021. So when you say who are the most active venture investors, actually they weren't venture funds in 2021. 22, that has come off, and we expect that to continue as a trend in 2023. In fact, in some cases, we think we will see some of these names and similar style investors exit the market in their totality, which I think is a good thing largely for the market. There are some good investors in this cohort of companies where they provide much needed growth capital. But what we were seeing is a continuum of investing across every stage at a pace that we'd not seen before. And frankly, with the size of rounds that we felt were unsuited to the businesses that were looking for that capital. So companies were over-raising, in some cases at inflated valuations, where we feel that their track record and their progress hadn't justified the amount both that they were raising and at the valuation. And there is a dynamic in the market where you will see a lot of fintech businesses needing to spend the next 2 to 3 years deploying the very heavy amounts of capital that they've raised and trying to grow into that valuation. So when we talk about, well, what does that mean for the exit market? And we read a lot in the financial press about the dearth of IPOs, that the IPO market is closed, and you can see the number of fintech IPOs this year, numbered 1 so far. I think when you go back over the last 4 or 5 years and you aggregate all the exits that have happened in fintech across the global fintech ecosystem, what you see is, yes, even in a banner year such as 2021, where we saw more IPOs than at any previous point, both in value and in size. Reality is that the vast majority of exits happen through M&A. So either through strategic buyers or through private equity. And that's a really important feature and dynamic for this sector, because for us, ultimately, the true test of our underlying performance will be in exits, will be in delivering realizations to our shareholders. And although IPO is one exit route, the reality is the vast majority of our underlying portfolio at the point at which they do exit will likely be bought rather than listed. Now, of course, it doesn't mean that you don't run a dual track process. And I think Interactive Investor is a great example of a business which we held for many years. Ended up being a fantastic outcome for us. We ran the dual track process, and in the end, a strategic buyer came in and was willing to pay I wouldn't necessarily call it a strategic premium, because I think the IPO range was on par, but it was an all cash deal. And I think in a market that looked like it was turning, it was absolutely the right decision for the business and for our shareholders as well. So are we in another situation that we experienced here in Europe when it came to tech investing in 2000? And I think we're in a really different place to where we were there. If I go back to 2000, I was involved with a business called Flutter, which eventually became Betfair. We raised venture capital in February of 2000, a month or two before the dot-com bubble burst. And I think after that point, what we saw in the European venture environment was a total disappearance of capital in the market for many years. It was a pretty extraordinary situation where we've seen this huge kind of wave of new investors coming in, embracing an emerging asset class in venture capital, and then frankly disappeared, having deployed huge amounts of capital. 20 years on, we've built a very different, much deeper, robust venture capital ecosystem that has a lot of experienced investors, where there's deep domain expertise, and where there's real resilience and depth in the capital base. Yes, we had a lot of tourist money fly into the sector, but if we look at the total amount of committed capital in the venture capital space, we are at a point, both globally and in Europe, where we have more what we would define dry powder than at any previous point in history. So we're not going to see an evaporation of capital. We are going to continue to see high quality fintech companies being funded in the European venture space. And I think what we will see, which will be a shift from the last 18 months, or I should say in particular kind of second half of 20 and the whole of 2021, is that capital will be deployed over a longer period. So the average venture fund on average should be deployed in a 3.5 to 4 year period. And what we were seeing in 2021 were a lot of funds coming in and deploying at a pace, at scale, at prices within a 12 to 18 month period. So the pace of deployment was too quick. It was, as we have previously alluded to in the slides a couple of minutes ago, we can see that the valuations moved to unprecedented levels and it was unsustainable. So, the crystal ball from my perspective is you have that depth of capital, but you will see it deployed over a longer period. So that 3 to 4 year period, it will be deployed at more moderated valuations, and the average round size will drop. So the money will go further. And in theory, the returns should be better for those venture funds who have capital, and hopefully for those of us who, held their discipline in 2021, didn't deploy huge amounts of capital, and as such will suffer the consequences of what, is likely to be a very difficult vintage in that particular year. So what are the incumbents doing? And I think this is something that I've talked about a lot to many of our investors over the years. And I think it's a continual surprise that they haven't been as effective as they would have hoped in terms of the amount of capital that they have deployed collectively in digital transformation over the past decade. There is still huge investment amongst the global asset managers, banks, insurance companies who have very significant balance sheets, but also massive digital transformation projects ongoing. And if you look at the combined spend that the traditional financial services industry has made over the past 10 to 15 years, it's a pretty extraordinary number. We're talking about several $1 trillion of investment. And when you look objectively at, has it delivered on that dramatic digital transformation that they were looking for, everything will point to the fact that a lot of the capital that has been deployed has been wasted. And this really is the opportunity for B2C fintechs, but also B2B fintechs as well, who increasingly are becoming far more collaborative as partners. The banks are becoming customers of these infrastructure players who perhaps a few years ago, the banks would sit there saying, thanks, but no thanks, we're building this ourselves. There is a recognition that it is not possible to build everything from within. And frankly, if you look at the amount of capital that has been deployed on these massive digital overhaul projects, in many respects, that capital has been written off by some of the largest financial institutions on a global level. So they will carry on investing on their balance sheet in internal digital transformation. In parallel with that, many of the biggest banks and insurers are becoming equity shareholders, minority equity shareholders in fintechs on a global scale, but as well are becoming increasingly acquisitive. And that is something that we expect to continue to see play out over the next 3 to 4 years in a meaningful way. And we are in an environment where the top 5, if we just give you the example of the top 5 UK banks and top 5 US banks, they're sitting on $2 trillion of cash. So in this interest rate environment, their balance sheets are being swelled. Fintech valuations are coming down and have come down to more moderated levels. So this is a moment where M&A becomes an interesting opportunity for them. There will be inevitable consolidation, but certainly something we expect to see continue to play out, strategic M&A in a big way over the next 3 to 4 years. So where are we in the journey? And I think there are 2 camps. There's those that believe that digital transformation is only part of the way through its evolution in financial services. And I think the data really backs that up. And of course, there are those that say regulation is a huge inhibitor of innovation. And as such, we don't expect there to be considerable digital transformation in financial services from this point. And I think if you have that view, and clearly we don't, then you would be going against the historic benchmarks in other industries that see far deeper penetration than what we see in financial services. It's pretty remarkable how little penetration the industry has had by disruptors to date. Now, you might sit there and say, well, doesn't that show you that fintech is struggling to cut through? We are and have seen hundreds of very valuable businesses already been built. We're talking about a revenue and profit pool in a multi-trillion-dollar global industry. So we're fishing in the deepest pool when it comes to an industry that has seen nowhere near the level of disruption that it should have. And regulation clearly has been an inhibitor, but increasingly central banks, domestic regulators are looking at stimulating competition, stimulating innovation to ensure the industry is fit for purpose for consumers and businesses alike over the next 40 to 50 years. So from our point of view, even in some of the most established sectors within fintech, we are still talking about single-digit penetration. So that means that there will be hundreds of very valuable fintechs that will be built over the next decade that don't exist today, or if they do exist today, they exist in a very small way in terms of scale. Our job is to make sure we identify enough of those to deliver that long-term return for our investors. But fundamentally, it is our view that we're halfway through the first innings, so there is plenty still to come. So hopefully I've set the scene, and I want to spend a little bit more time on the market update, giving you a sense of what we're seeing, what we expect over the next year. I will be a little bit more accelerated on the results and the portfolio update, and certainly we will, if not already done so, share this presentation so people can look at it in more detail. Do feel free to ask some questions of me at the end of this. But what are the key metrics that I would like our investors and prospective investors to really think about when they look at the most recent results which we put out last week? And I think the 2 key numbers to keep an eye on are one, that the NAV has stayed stable. And the NAV has stayed stable despite the fact that clearly we've seen a backdrop of very difficult macroeconomic conditions. The underlying portfolio, so the top 10 assets that make up around 3/4 of the invested NAV, have grown on average over that period about 100%. So still good, strong underlying growth. For us to be a top decile performer, we want to deliver across the long term an IRR of about 20% and remain on track with that since IPO. And as importantly, we have built up a pretty significant cash buffer. We have always been resistant to being heavily weighted towards cash. We are at our highest cash position since IPO, and that is a deliberate strategy. Yes, we want to avoid cash drag, but we feel in recent months the market wasn't delivering what we felt was enough propositions where the risk we were prepared to take was being reflected in the price that was being asked. And as such, we want to be armed for the time in the market where pricing does move back to what we think is the historical norm. And we think in 2023, there'll be some really interesting investable opportunities for us, and we want to be able to kind of capitalize on that. So if I give you a quick snapshot of the portfolio, what's been really important over the last 4 years since IPO is to kind of build that diversification, across a number of subsectors. Now, what you will see here are some sectors where we feel we're underweight, some where we have kind of been building over time, and some where we feel we've got sufficient exposure. But at the same time, as portfolio company exits, Interactive Investor being one, which was a big chunk of the portfolio, therein lies the opportunity to look at our underlying strategies, look at the thesis development and say, do we want to kind of ensure that we've got more exposure in the wealth and asset management space? Are we happy with our balance? Or do we want to kind of over-index now on payments? And certainly when I look at this relative to where we were 2-3 years ago, the left-hand side, the infrastructure piece, the payments piece in particular, were areas where we felt we were underweight. We really did want to kind of build that out, and that has started to really develop nicely with a number of kind of emerging companies in that space. So you've got a really well diversified portfolio. I'm going to jump quickly and then I'll come back to that, but I just want to talk about maturity, because it is as important to have good diversification by subsector as it is in maturity. We are, a permanent capital vehicle, and we're in the business of taking early stage risk. And as a result, what that means is that, frankly, not all of our early bets are going to pay off. We need to make sure that we've made enough of those early bets where those that start to kind of break through and deliver on that early promise, we can continue to invest and support. Now, alongside that, for the journey for these companies can be a long journey, it can be a 7, 8, 9-year journey. And as patient as our investors say they are, I don't think they want to wait 10, 15 years to see the first exits. So it's really important that in our portfolio construction, we have the weight of our NAV, the overall percentage, closer towards that kind of mid to late stage. And you can see here, we have a number of companies, over half the NAV currently towards the later stage. And what does that mean? It doesn't mean these businesses have stopped growing. They're still growing at a fairly nice clip on average at 45%, and actually they're depressed by a couple of businesses that haven't grown. We've got some fantastic kind of growth stories there. But we would expect the exit horizon for these businesses to be within 12 to 36 months. It doesn't mean that one of our businesses in the mid or early, there is someone that comes in opportunistically and looks to acquire, and it's a compelling offer, and we decide alongside our fellow investors to take that. And it also doesn't mean that we absolutely have to exit these later stage ones, but it does give confidence to the investors that there are going to be realizations, which is going to allow you to continue to reinvest in the vehicle in the next generation of companies, and you have that follow-on capital for some of these early stage companies to be able to support them as those that really do break through and justify further capital. So just in terms of RR, and I'll touch very briefly on this, ultimately for us, I think the true test of, have we done what we said we were going to do is in delivering that long-term target return. And as I said, if we can deliver it in and around 20% high teens, then we will be a top decile performer. We're on track. There's a lot still to prove. We've started to have some, compelling exits at Interactive Investor being, one of those outliers with a RR in the high 80s and an 11 times return, and we need exits like that because that really kind of allows you to take that early stage risk, which we're very much in the business of doing so. So what have we been doing in terms of deployment? And we haven't been that active. And we said we were unlikely to be active in the period just reported on, and that is because, as I said earlier, we have a portfolio in 2021 that took the opportunity in a strong market to raise capital and is largely well funded, has a cash runway for those businesses that aren't profitable, which is the majority of them, because we're continuing to invest in growth of 22 months. But we did invest in a small way in those businesses that needed top-ups, but also looking for those exceptional opportunities. And we found in KIP, who are based in Tel Aviv in Israel, a really interesting business in the payment space that is doing something really differentiated, very high caliber founder team, and one of which we felt stood out from the crowd. And that's really what our job is to do, is to find that needle in a haystack, to find exceptional businesses, companies doing something fundamentally different, solving significant pain points. And if they get it right or can execute and deliver, then they can build a really valuable business. So in terms of the movement, and I won't dwell too much on this slide, but this has been a real shift overall in listed private equity and listed venture, where if there weren't third-party investment rounds, there wasn't much movement in the underlying portfolio. The international private equity guidelines and the interaction with the auditors as such is that they see a lot more movement between investment rounds. They are looking at listed market comparables and taking that. So it doesn't mean if a portfolio company has dropped or increased, it doesn't necessarily translate to business performance. It might well be that the data set of public market comparables that are being used for that particular company has seen a significant retraction in the market, and that has kind of reduced that accordingly. So what does that mean? And I'll come back to the multiple slide in a minute. If we were to use the same methodology in terms of multiples that we used back in the end of March, we reported those in June, July, actually we would have seen a 20% uplift in our NAV. But as a result of the multiple contraction and the sell-off in the public markets, the applied multiples that we used negated that underlying growth in the portfolio, which largely left you with a flat number. So valuation deflation in the markets has counteracted the growth impact. So we feel that we can stand behind a really robust NAV of 155, and that our discount is not justified. So why can I say that we shouldn't have written our valuations down relative to the listed tech market and the listed fintech market in particular? And here's a really useful chart that shows you the evolution of the high growth listed fintech index, largely US listed fintechs. And this is the forward revenue multiple that was being applied according to their valuations. And you can see it went to unprecedented levels in March 21, was as high as low 20s. So companies being valued on average at forward revenue multiples of 20 times. The purple line underneath is the Augmentum approach that we have taken. And you can see it's kind of hovered between the historic average, between 4 and 6. And if you look at the long-term global listed SaaS index, that would be, and that would be listed, that would be between 6 and 8 times. So our average revenue growth of our top 10 is around 100%. This high growth listed fintech index would be in the mid 30s. So we have businesses, yes, not as significant in size or as mature, but growing at a far greater pace and are valued at a discount to the market. And yet when the listed market was trading at 20 times plus, we were holding ours at, if I show you March 21, at 5. And so there was no justification for us to sit there and say, we're writing everything down, because we never wrote it up to the same extent. And you can see now we're, holding everything at a 4.2 times. So a real, historic low for us. But we would rather err on the side of prudence and give investors confidence that the underlying methodology and approach that we use is robust and let us surprise on the upside rather than the other way around. Final thing I'll say on valuation is just talk about downside protection and what do we mean by that. And this is a concept that's always kind of hard to articulate effectively to both retail and institutional investors in the public markets who are unfamiliar with venture capital. But in all intents and purposes, when we talk about having downside protection in the majority of our underlying portfolio, it is because we would put in a class of share, which we would call a preference share. So to give you a hypothetical example, if we invested £5 million in a business that was valued at 25, after our investment, the post-money valuation would be 25 million. If that business did not succeed, but it sold for £5 million a year or two later and hadn't taken any further capital, that money that would come back would go to us first. So we would get the first 5 million. So in short, last money in, first money out. So many of our businesses would have both a preference share, but also anti-dilution, where in that same scenario, if the business raised more capital at a £10 million valuation as a result of poor performance, and the market said, we'll give you more money, but it will be a lower valuation, there would be new stock issued to us as a result of the dilution we would have felt as a result of what we would define as a down round. So we have this downside protection in the vast majority of the portfolio, and it is an essential mechanism whenever we invest at the early stage. So you will not see us invest without that structure in place at the early stage, because we're taking significant early stage risk. We're reliant on exceptional execution of a management team, and the reality is it doesn't always work out. And where we can get protection, we absolutely will. So before I open up to questions, just wanted to give a little bit more granularity on the top 10, the bulk of the NAV. Is the growth concentrated? We're often asked, saying, okay, it's an average, but let's get under the hood and see. And here you can see that you have the top 10 and their relative growth rates, and the majority of the portfolio is growing very nicely. And I would say that some of our portfolio companies will be somewhat immune to very difficult macroeconomic conditions. Some actually will thrive in the unpredictability. We do believe there are some of our businesses that are counter-cyclical and will do very well in this environment. Of course, there are some that absolutely are impacted by a difficult macroeconomic environment. However, in many of those cases, these businesses are still growing incredibly well. Why? Because they are fast-moving, dynamic propositions that businesses, depending on consumers alike, are shifting to at the expense of the financial services incumbents. And I think Tide is a great example. A business that was 4 or 5 years ago, tiny business, was a real scrappy challenger trying to disrupt the SME digital banking sector. And we sit here in 2022, a business with 8% market share, with nearly 500,000 small businesses that use Tide as their banking platform. And yes, small businesses are going through a very difficult economic environment, but it's a business that has grown close to 70% this year in the face of some very difficult headwinds. So these are businesses growing despite the challenging headwinds, because they're fundamentally doing something different and operating a platform that consumers and businesses alike are embracing relative to what they have been used to. So I will finish up with just a brief summary and highlight of what we think is coming down the pipe from a deal flow point of view, from opportunity. We are at historic lows in terms of conversion rate. Not surprising, not because we're not seeing a number of compelling fintech companies out there. What isn't compelling has been the pricing. And as such, when we have lost deals or we submit a term sheet, historically our conversion rate was very high. In the last 12 to 18 months, it's been very low. And that's because we weren't prepared to match what we felt were unrealistic pricing. And what we often talk about, our philosophy is not every good business makes a good investment. And frankly, over the last 12 to 18 months, we've seen a lot of good businesses that would have been terrible investments. We think that will change, and we expect our conversion rate to increase over the coming 12 to 18 months. But it is important we remain disciplined. We're here for the long term. We've got to back exceptional businesses, exceptional founders. But fundamentally, we are very well positioned. We have a huge network in the European fintech ecosystem. We have built up a database of 2,500 fintech companies that we're tracking, we're monitoring. We've built relationships, and that gives us what we think is proprietary access to a market that is hard for those coming in for the first time to build that exposure to. And this is not an exhaustive list, but this just gives you a little peek under the hood of some of those areas where we either want to build our exposure further or we want to develop exposure for the first time. Not that insurance is a new concept for us, not that insurtech hasn't been an area of real focus. And we would have looked in great detail at probably north of 100 insurtechs over the past few years. Fundamentally, though, we are very clear and explicit as to what we're looking for in that particular area. We're looking very closely at some emerging themes, one of which is cyber insurance, and certainly something that we're taking a very close look at as well. So I'm going to pause there. I'm going to take a look at my watch. I think I spoke for just over 30 minutes, so apologies for dragging out, but hopefully that has given everyone a really good appreciation of, one, where the market has been, where it's going, and our role in the ecosystem, and what we are expecting to see over the coming 12 to 18 months and beyond. Matt,
Brilliant. Thank you very much, Tim.
Do we have any questions?
Yeah, we do. We have quite a few questions. So the first one is, do you think the recent failure of some of the cryptocurrency platforms will have any contagion and negatively impact fintech valuations on a wider basis? And has it changed your view of some of your investments in that sector?
Yeah, very good question, very pertinent. I was in New York a couple of weeks ago. We have an investment in a business called Gemini, which is a digital assets platform, both exchange, custodian, amongst other things. And I think the thesis that we had there, and we spent many months looking at a large number of players in the market, and our view was that there was increasing institutionalization of the space. For the part of the sector that was here for the long term. We have no interest in the wild speculation of tokens. That's not something that you will get as a result of your investment in Augmentum. But we wanted to look to find those that understand the importance of regulation in the long term, that recognize that, if the sector continues to institutionalize, then they would need to build institutional grade infrastructure. And that was really our decision, to back the likes of Gemini, who are based in New York, working with a New York regulator, are backed one-to-one and operate in a very different way to the likes of FTX. So I did meet FTX. I have met SBF, albeit remotely a few times. We did take a look at it in the earlier days, so long before it became the Goliath, and then obviously the collapse that happened. And I think what was very clear to us at the time, that although you had a very entrepreneurial and talented founder in many respects, it was being built in a way that made us uncomfortable. We felt the regulatory focus wasn't there, that they were paying fast and loose on regulation, and they didn't have a long-term vision. So I think those long-term winners, assuming that digital asset space can navigate what inevitably is a very tricky path. And if I'm totally honest, we saw a very similar dynamic, albeit not at the scale that we see now in digital assets in the betting industry. When we built Betfair 20 years ago, there were a number of emerging exchanges operating in exotic locations, such as the Caribbean, that went bust, dipped into client funds, and where we could at Betfair, we bailed out the customers. We certainly didn't bail out the businesses, because we felt that it was important for the credibility of the industry for somebody to operate in the right way and look after customers. And so we've seen this story unfold before, and yeah, hopefully it will play itself out. A lot of the cowboy operators will fall by the wayside, and those that really understand the importance and the power of what's being built in the blockchain, those use cases that we think are really compelling and fundamentally make, in many respects, financial services ultimately a more efficient, transparent, and lower cost proposition will come through. And the wild speculation can be a bad memory when that plays through. So, our overall exposure is limited to infrastructure in that space. It's single digits. It's not something where we felt we could ignore, but at the same time, this is the beauty of diversification, where we have some exposure. We feel that we've picked the right horses for the long term, and hopefully time will prove that out. Certainly, the early indication is that we were right to pass on some of these operators that got to scale very quickly, but are falling equally quickly as well.
Brilliant, thank you. HSBC recently invested $35 million into Monies as part of a strategic partnership to focus on banking as a service. How does this change the valuation for Monies, and do other companies in your portfolio have the potential to develop and monetize their own as a service offerings?
Yeah, it's a very good question. Actually, it's an interesting one. If I'm totally honest, when we invested in Monies, we invested very much as a B2C digital banking proposition targeting the immigrant and expat community. They were doing something quite different to the likes of Revolut and Monzo, and they've had reasonable success. But it's not been a business that has quite delivered on the early expectation, albeit it has made a lot of progress. What we did really like about the business and the team when we backed it was a truly exceptional tech development hub that they had built in Estonia, and all the due diligence that we had was that this was best in class. As the business evolved, there became an opportunity with Investec initially, who had been in the market looking for a third-party provider to build its software, had talked to a number of the pure B2B players, so the likes of, there's a Mambu, there's Thought Machine, there's 10x, Future Technologies. There are a number of pure play B2B banking as a service, platform as a service. And the conclusion from them was that what Monies had built and could build was the most compelling. And I think that has been validated as a result of HSBC spending the best part of 18 months. And you can imagine the number of consultants that HSBC brought in to analyze the market. And they decided that Monies could build what they felt was the best-in-class platform for them, which hasn't been announced exactly what will be built. But you can imagine it's a pretty considerable proposition. In parallel with that, they felt the strategic benefit of becoming an equity investor in Monies was compelling, and they invested $35 million. It's an interesting question on valuation, and I think comes back to my previous point on how we interpret valuation and trying to err on the side of conservative. Because the structure of the deal is such, it could convert into equity at quite a wide range. We're holding it at the floor of that range. there is another listed fund that I don't think it's fair for me to mention who it is, who are a investor in Monies and have valued it at a price 60% above where we hold it per share. So same holding, same class of share, but the price per share is being held halfway up to perhaps the ceiling that it could convert into. So I think just for us, we just felt it's prudent. Let's focus on valuing it at the base case, and hope to be pleasantly surprised, and our investors to benefit accordingly. So I think that's a good example of our approach to valuation.
Brilliant. How is PropTech faring in a more difficult backdrop for property and mortgages?
Yeah, I think it's fair to say PropTech's been a huge disappointment. Overall, if I was to generalize, I think if you look at the amount of venture capital that has been deployed in PropTech, and obviously there's an overlap with Fintech, and we have a Fintech / PropTech thesis, which is pretty small from memory, maybe 1% exposure. Our investments to date have been rather underwhelming. We haven't. It's been an industry that has struggled to embrace digital transformation, and I would say it's certainly one of those that's work in progress. I still think there's a lot of potential. We've backed a really interesting business called Wayhome, which has launched, which builds a proposition as an alternative to a mortgage. It has pension fund institutional backing underpinning it in terms of the assets, and it allows those consumers that we would define as generation rent to actually own property rather than burning a lot of their hard-earned money in rent. So it's a really interesting proposition. If you haven't heard of the business, then you should go and have a look at it, because we think it's a type of concept that's very innovative. It's a hard business to get to scale and get to the point that they have to have attracted 100 million of pension capital to be able to purchase these homes alongside the customers as well. But that's certainly a product worth looking at, but is a small position for us, but one in which if they can cut through, we'd certainly look to support. But yeah, I would put the PropTech industry, I give that a 5 out of 10 so far, and yeah, hopefully there can be some real cut through, but it's been a big disappointment overall.
Thank you. Could the higher interest rate environment, one, accelerate the deployment of cash buffers, and two, lead to a series of deeper repricing across private assets, especially leveraged ones?
Sorry, Matt, I lost you for 5 seconds. Can you just repeat that question?
Could higher interest rate environments accelerate the deployment of cash buffers and lead to a series of deeper repricing across private assets, especially leveraged ones?
I mean, yes, it's possible. Venture doesn't have a lot of leverage. We have no leverage at all. Private equity, of course, will use leverage far more. But venture capital, because these businesses tend to be high growth, loss-making, burning capital, it's very limited leverage there. So you don't have that same impact where higher interest rates can be existential for many businesses. Of course, there's always exceptions. I think it plays to an advantage for some of our businesses. Clearly, we have some lending businesses that have been trading very well. The likes of Zopa, which became a bank, is trading exceptionally well. The net interest margins, obviously the spread, is playing to their benefit. So I think one never wants to be overly flippant or complacent about the macroeconomic environment, because it is going to be challenging over the next 12 to 18 months. And I think high interest rates, pose lots of different challenges to consumers and businesses alike. But I wouldn't say it is the existential factor, certainly in our portfolio. And I would say, as a rule, I wouldn't say for venture it is particularly impactful. I think the repricing point, will we see an acceleration in revaluations in the market? I think we've not seen the full extent of the fall for sure. I think we expect more moderation in valuations next year. I think what you're not going to see those businesses that raised huge amounts of capital last year at very inflated valuations that frankly would not be able to go back into market to raise money at the same level. So in that situation, if I'm an investor or I'm the CEO or founder of that business, I'm going to spend the next 2 to 3 years trying to grow into my valuation by investing that capital well, and not having to go back to the market and have that very public down round. And you might well find those, some of those businesses do grow 150, 200% compound over 2-3 years and grow into the valuation that they achieved in 2021. Of course, not everybody's going to fulfill that potential, and that's when you'll see those very public down rounds. But largely, yes, we see a lot of headlines about the marquee names that raise huge amounts of capital at very significant valuations, but at the same time, there are a lot of high quality businesses that were pretty sensible, raised money, but also didn't just take money from those that put the highest price. They took money from investors that they felt would really add some value and be there for the long term. And I would say, as you would expect me to, that a lot of our portfolio companies did that and avoided some of the pitfalls that we're seeing play through this year, but we'll see play through more next year.
Could you just perhaps go through the evolution and exit of your investment in Cedars?
Yes, well, we exited Cedars last year. It was, as an investment, it washed its face. Sometimes investments don't go to plan, so we got our money out, which was a positive outcome. I think there was a lot to like about that business where we first invested. I think, for us, we felt there was an opportunity for a platform to become the true private market repository for all things private company in the UK, whether it's EIS, SEIS management, payment flows, certification, shareholder management, cap table management, private capital raising, communication to private shareholders. There was this whole vision. It stayed very much to its kind of initial vision of obviously becoming a pure fundraising platform for early stage companies. And I think it never quite extended to the product set that we had hoped and expected it to. So we drove a merger with Crowdcube, which the CMA, with the benefit of hindsight, I think were wrong to block. A bizarre decision in my view, and I've said that publicly. And as a result, it drove them in the hands of a foreign buyer, and that was an opportunity for us to take money off the table, which we did. So we like the team very much. We're kind of hopeful that they can really kind of build the business that they deserve to do, but not everything kind of work out as you hope. So we took the money off the table, and we're as always look to reinvest in the next opportunity.
How's the UK government supporting the growth of fintech industry in this country?
Well, successive governments, to be fair, I can be critical about lots of things that governments have done in recent years. I think the one thing that they've all collectively done is they've been very supportive of the industry, alongside Central Bank of England, obviously the regulator as well, the FCA in particular. One doesn't lavish praise on a regulator too lightly, but I think post-financial crisis there was a very clear recognition that the UK is the global financial services center. It's a huge part of our GDP, 12-13%, and we were very well positioned to become the bastion of innovation in financial services, and I think that's played out. And so we've attracted a huge amount of capital. So 50p in the pound of every penny of fintech venture capital in Europe is in the UK. Which is a fantastic outcome for UK PLC. So I think fintech continues to punch it well above its weight. There's of course more that can be done. We would love to see more capital unlocked by pension funds. We believe the removal of the fee cap on pension funds is incredibly important and will bring a lot of further growth capital to the ecosystem. why are so many overseas pension funds investing in UK venture capital and UK fintech, where they're taking those returns back to whether it's Canada or Australia? Why aren't UK pensioners benefiting from some of our great success stories? And so I think we have a very aligned view at government in terms of what needs to be done. It's just taking a little bit too long. We've for those of you who are at our Capital Markets Day, we had the then Digital Minister there who spoke very openly about his desire and priority to get that through. So we'd like to think in the year ahead that we will unlock a lot of capital. But yeah, overall, I think fintech has a very good profile, has a seat at the right table at government, and will continue to do so.
Brilliant. There's a lot of talk about the reduction of IPOs, and one could argue investors are too focused on them as an exit method. Does Interactive Investor prove the concept that it's not all about IPOs and other routes to exit are equally profitable? And are you optimistic for the future?
Yeah, I think I showed a slide on that. If you look at the last 5 years, you aggregated all, I think 94% of all exits for fintechs have been through M&A, 6% IPOs. So it is one route, but the likelihood is, and the high likelihood is, that when fintechs exit, they will exit to strategics or to private equity or to others. So yeah, I think I'd love to see a buoyant IPO market. I'd love to see a higher quality cohort of fintechs on the London Stock Exchange. It's a general challenge, as many of you will have read, bringing more high quality, high growth tech companies to the London markets. It's a cultural challenge. There's obviously a challenge for the analyst community as well to get comfortable, and I would say the business press, with what it takes to build a really valuable listed tech company. There's too much focus on short-term profitability or lack of it, and not enough focus on the long-term potential of some of these businesses. There's a huge amount of cynicism. I think the American investors, it's fair to say, are much more glass half full when it comes to future potential, whereas we're more cynical here in the UK, and I think that's been a cultural challenge. I think it's shifting, but it's not shifting as quickly as it should. So I think we will see more, but of course we need more success stories on the London market to fuel more confidence for techs and fintechs to want to list here. And I think is a great example, where I think timing was right. I think it will turn out to be a great asset for Aberdeen. I recognise they've got their own challenges, but it's a business that is very resilient, very sticky, and I think will be a huge cash generator for them in the long term.
Brilliant. Grover has been a fantastic investment. How hard was it to get to grips with specific consumer behaviours outside the UK? And do you think Grover can break the US?
Yeah, I can talk. One of the teams sits on the board of Grover, so I wouldn't say I'm the German expert here. I mean, I think what's interesting with that business was it wasn't an obvious investment. And I think I probably, at our investment committee, applied a very British view as to why would millennials, Gen Ys, Gen Xs rent rather than buy. And I think what became quite clear that there was very different consumer behavior amongst that AV consumer in Germany, that culturally renting is clearly a thing that we don't see here. So I think that has really surprised on the upside, and hats off to the team for the execution that they've done there. I think the US is an interesting space for them. They've launched there. I think B2B is really where they're looking to expand. The early numbers are quite encouraging, but I think it's quite early there. But it's a business that certainly has come out of the shadows and done tremendously well. And I think that is a good example of a business that actually in this economic environment is proving to be very resilient. And so far consumers and businesses are showing an increasing desire to want to rent rather than own.
Great, thank you. That completes the hour. We do have a few questions that haven't been answered, so we'll get round to answering those. Some have submitted them anonymously, perhaps by mistake, but if you could email those questions to distribution@frostro.com, we'll know who they're from and we can answer them. But Tim, thank you so much for your time. And also thank you to all the attendees today, and look forward to talking to you soon. So thank you very much, Tim.
Thanks, Matt. That was great. And thanks for everyone for taking the time to listen in.
Thank you. Bye.